Can you move your properties in your own name into a limited company? What are the tax implications? What do you need to know? I'm going to tell you everything about this in today's YouTube video. So you've got properties in your own name, and Section 24, last year it came full into swing, so which meant the mortgage interest is now not a tax deductible cost. You're probably only getting a 20% tax credit on the amount of finance cost you're paying, some people even less. So what this has done is basically it's completely changed the landscape, and now for a lot of people, property investment through your own name doesn't make sense. You're probably paying a lot more in tax than you were before, and some people we actually speak to, they're paying 150% in tax because they lose certain benefits, might be losing child benefit, losing their personal allowance. What actually happens is the amount of tax they pay outweighs the actual cash flow they get from their property business. What this has led many people to look at doing is incorporating their property businesses. This is basically the terminology of where you transfer the properties from being owned personally in your own name into that of a limited company. The advantage of doing this is a limited company only pays tax at corporation tax rate 19% currently, and mortgage interest is still a fully tax deductible expense. So for a lot of large landlords and people that are 40% taxpayers, trying to get your properties into a limited company can be a very tax smart thing to do. However, there are two taxes you need to be aware of. The first is capital gains tax. So usually where you make a sale between yourself and your limited company, this is deemed to be a market value disposal. And essentially what HMRC will look to do is apply a market value to this sale. So they'll tax you, the individual, as if you'd sold that property on the open market for its full price. Now this presents a problem because you've not got the cash to pay the tax bill, and you probably don't want to pay the tax bill. So that's the first tax we need to be aware of. And then the second is stamp duty. The limited company buying the properties from you will pay stamp duty at the additional rates as well, so the 3% surcharge will be in point on the market value of the property purchase. So therefore, people that are transferring properties that are quite significant in value, that have high capital gains, the tax often isn't worthwhile in actually transferring them over. Although you might be paying more in your own name, for most people it might make sense to either repay the mortgages, sell them, or do something else with the properties such as service accommodation if they can. However, for some people with large enough property portfolios, you can actually incorporate them into a limited company, completely avoiding capital gains tax and stamp duty. Effectively, the way this is done stems off of the technical definition of what is a property business. There was a case that went through the course quite a few years back now, and it's basically the Ramsey case is what it's called in the tax and property world. And essentially, Mrs. Ramsey was working 20 hours a week in her property business, and it went through the various tribunals, and the long and short of it was that HMRC had to accept that she was running a property business because she was working 20 hours a week in her business. And this made incorporation relief available. And what incorporation relief does is it allows you to roll over the capital gain that would have incurred against the base cost of the shares. So effectively, you don't pay any capital gains tax now. You only pay capital gains tax when you come to sell the property, or even then, if you're going to keep this as a long-term investment, you might never sell the property. You might pass them on to your next generation, in which case they'd get a tax-free uplift as part of your inheritance tax calculations. So if you are working more than 20 hours a week in your property business, incorporation relief should be available for you. Typically this could be 5 or more properties, but if the HMOs are quite intensive, then this can be a part of the factor. And also if you're using letting agents, that's not a problem. A letting agent carrying on work on your behalf still counts in that 20-hour a week principle. So that's the first tax that's been sorted. And then the stamp duty. Well, here, if you're running your business as a partnership, there are some quirks in the stamp duty legislation that basically say if the shareholders remain the same as the partnership shares when it gets incorporated, there is no stamp duty on the incorporation. This gives little choice to people that are landlords trading as individuals, if you're not married couples, if you've not got a business partner, because ultimately you do need this partnership angle in place in order to benefit from this. But a lot of people, do trade as a partnership, are married couples. So this incorporation route is very, very feasible. So they're the two taxes, capital gains and stamp duty, and this is how we avoid them. So as long as you're working 20 hours a week in your business, and you're doing it as a partnership, then you should be able to incorporate with absolutely zero tax to pay now. If you do want to find out more about this, drop it in the comments, book a call in with myself. I'd love to have a chat. Otherwise, make sure you give this video a big thumbs up and subscribe. Bye for now.